Hello, everyone. I'm Diane Damsky. I'm head of the Secretariat of the Operating Principles for Impact Management, and I'm delighted to be here today moderating the first in a series of joint webinars between the Impact Principles and British International Investment. The topic of today's webinar is investor contribution, best practices for impact investors. We have an incredible panel with us here today. So the webinar will begin with an introduction of the panelists, and then there will be opening remarks by each of the panelists, followed by an interactive discussion on the key areas of investor contribution. And with that, I'd like each of the panelists to briefly introduce themselves. And so Julie, would you like to start?
Great. Hi, everyone. Good afternoon and good morning. I'm Julie Wallace, Head of Impact at LeapFrog Investments, and I'm participating from London today.
Rob?
Just been having the fire alarm test. I was just waiting for it to finish before I unhit mute. I'm Rob Davies from British International Investment, the UK's development finance institution. We're one of the founding signatories of OPIM and with the impact principles and on the advisory panel since its inception. So great to have this session here today. I head our development impact investments team, which is a team of 25 responsible for managing the impact of our transactions from inception to exit.
Great, thank you. And Andrew?
Hello, thanks for having me. I'm Andrew Lee. I run sustainable and impact investing for UBS's Global Wealth Management Division. So happy to be here with everyone.
So now each panelist will provide some opening remarks. How do you define and approach investor contribution? That I will start with Rob.
Thanks. And it's just fantastic, I think, to be having this conversation here today and see so many people interested in the question of contribution. I think often it's the thing we can do most that moves the needle on the change we see in the world, but it's so hard to demonstrate and get your finger on that often the conversation doesn't get had as much as it can. So fantastic to be having this discussion. How do we think about investor contribution? So we really think about it as how does our investment change the real world outcomes for people and planet in a way that they wouldn't otherwise happen. So we're really trying to understand what changes there in the world as a result of us, British International Investment, being part of a transaction. To break that down, how do we think about operationalizing it? So we think about what we call the nature. You can think about this as the how you deliver contribution. Other people call it the channels. We break it down into two broad components. The first is where we provide capital to a transaction. So thinking about whether we provide capital which isn't available in the same way, or providing value and advice to a transaction which also isn't available in the same way. I do just want to pause on the capital part because as a publicly funded organization, we're not subject to the same market dynamics for fundraising that private impact investors are. And that does place a sort of extra onus on us to make sure we're not crowding out private players. We're not passing through that lack of competition in our cost of capital into the transactions we're funding. And that means we take a very cynical view as to anything which is about sort of cheaper cost of financing, because that cost could just be a result of our cost of capital. So we don't look at that in our contribution, and we're very careful to think about whether we're crowding others. But how on earth do we turn this into practice? And I think one of the core components that we hold very dear on contribution is to sort of get beyond the idea that it's definitive or binary. And I think the statement can be very definitive, so you're changing the world that wouldn't otherwise be there, but you can't assess that. The only way to tell if something wouldn't happen if we didn't do it would be not to do it. And as an organization that wants to see change in the world, that's not a great way to get the job done. Similarly, if we do something, we don't know if it would happen without us. So we have to be comfortable in the gray and uncertainty of it. But how do we do that well? How do we operationalize it? So we focus on being pragmatic in the way we approach it, asking the right questions, assembling as much evidence as we can, and putting them together in a probability confidence assessed basis to try and take the best decision we can. We break it down into two components. We think about our confidence. We're offering something another investor wouldn't. But we have to be quite humble in our ability to get that decision right. Markets are dynamic, they're ever changing. It's very hard to know whether somebody else would make another investor. Sometimes it can be completely clear in a very nascent, maybe fragile markets. In other cases, it's very difficult. So our confidence helps us put that on a spectrum and understand just how clear we are on it. Secondly, we think about our scale. So we may bring something that another investor wouldn't, but it doesn't really make much difference to the impact being had. We want to focus on those things which really move the needle on impact. So it's not just about bringing something different, it's about that thing we bring is really important for the impact of the transaction. So putting together our confidence and our scale helps us understand how significant we think our contribution is. And I think one point that's really important to understand is, to the point of never quite knowing what the counterfactual would be, having false positives and false negatives both have costs. So we don't aim to be overly conservative. We aim to try and get this decision right on average, but be humble that we're not going to be right all the time. We can't observe the information. We just need to do the best thing we can. So we bring these pieces together and we take a view that we should rate contribution. And this, this is a little controversial in the market as to whether it's something that should be yes or no, or something that you put different rating levels on. We believe that by rating it, it gives us a better view of trying to get those decisions right more of the time. And then when we bring together our impact decisions, we're looking at what is the investment impact we're going into. So how much impact do we expect the overall investment to have? And then we look at that in a multiplicative way with our contribution. So how much of that do we think is as a result of us? And obviously, if our contribution is zero, the impact BI would have for investing in that transaction, no matter how great the impact was, would be zero. If our contribution is very high, then a larger part of that impact we're responsible for. And that allows us to trade off high impact, lower contribution transactions with lower impact, higher contribution ones, and help us make sure we're right more of the time.
Thank you, Rob. That was a wonderful overview of what you're doing at British International Investment. And you made a great point of, as a development finance institution, what you're able to do on the capital side is different than in the private sector. So Julie, let's go to you next and talk about, as a private sector asset manager, and your approach to contribution.
Great, thank you. So a little context on LeapFrog. We are an impact-focused investor working across Africa and Asia, and we're focused on health and financial services. So for us as an impact investor, contribution is really key and central to our approach. We think of contribution as the unique value creation we can work together with our portfolio company to help them reach more emerging consumers with health and financial services. So our focus is pretty clear, health, financial services. So that really opens up a pathway for us to co-create with the portfolio company value creation initiatives. And when we think about that, we're mindful that we want to provide additional value and expertise and steerage and guidance that maybe other investors couldn't provide. And so for each company, we have a theory of change that sets out how we see and how that company sees their contribution to social change around financial services or health. And then within that, there can be a range of value creation activities. It could be product design or talent development or risk management, or we spend quite a bit of time around E&S processes and impact processes at the company. I mean, what I found really interesting in this space is that the whole concept of additionality and unique contribution is that oftentimes these companies have many other investors who also are promoting ESG and impact principles and concepts, but then we'll find that those companies don't yet have environmental and social action plans, or they don't have some of the initial frameworks around value creation. So we'll spend quite a bit of time working with companies on these core components of ESG and impact, and also a lot of time on product development. So another investor could have done that, but we find that they aren't doing that. So for us, we see this as a unique contribution that we're bringing. And all of this is really done in parallel with our impact team, our deal team, and the company, making sure we have a plan that's really aligned with the value creation ambition of the company.
Thanks so much, Julie. And now, Andrew, I mean, UBS is a very large organization, but you also have a piece that is you're an asset owner. You are bringing capital to the impact market. So it'll be really interesting to hear your perspective on your approach to contribution.
Sounds good. And look, I think I'll touch on some things that that both Julie and Rob referenced. We do play a slightly different role in the broader ecosystem. We are a large global wealth manager, so as such, we either discretionarily manage or we advise on sustainable and impact investments and portfolios for our private clients. And so, at the impact end of the spectrum within the broader sustainable investment umbrella, where we and our clients are looking for those investment solutions that really are intentional about driving positive change, going well beyond alignment. I think investor contribution is really a key element of what we're looking for. So, for us, I guess at a high level, contribution, whatever level of the investment we think about it at, it's really what the investor does actively to drive or enhance that positive impact with his or her investments that otherwise wouldn't have occurred, as Rob was saying. And I think that counterfactual is really the key element to it. Like in the absence of that investor, whether it's Rob or Julie or ourselves, would that impact have been realized? And so I think the two primary levels that we think about it on are first more what Julie outlined, right? The contribution that our fund manager partners, all the asset managers that we work with around the table, are doing in the implementation of those impact investing solutions. So because we look at it across asset classes, the contribution, I think, is going to be specific to the manager and specific to investment strategy and process. And we think about it generally as part of our diligence process, right? So how are they driving the impact that they're looking to achieve within what we're looking to achieve in the particular theme or outcome area? So is the capital differentiated, right? Is it new capital? Is it cheaper capital? Is it capital that wasn't there before? And so everything to do with the movement of capital. And then the investor actions alongside that capital. What specific expertise are they bringing to bear? Are they making introductions? Are they helping, is it technical assistance with impact measurement and management? Are they actively engaging, with corporate management to help identify and drive material change? Again, across asset classes, it's going to differ. So, those are the two kind of things that we think about: the differentiate capital and the actions. And as much as possible, those should be clearly attributable to the investor themselves. So what Julie was referring to, lots of investors around the table, is that investor's action particularly attributable to them? And then the other level that we think about it on is our level as an asset allocator or an intermediary level. So comparable to some of the things that Rob was describing as an asset owner. How do we influence the asset managers that we work with to change their behavior and their intentionality of all the things that we've discussed above, right? How do we make our own allocation decisions across portfolios in a way that moves capital towards more impact-focused solutions? And so I think on these two levels, they're distinct, but they're complementary and they work together. And I think if you have additionality on both of those levels, you can really contribute to more explicit focus on outcomes and impact where the end client or end investor is really looking for those two things.
Great. Thanks to all three of you. We're going to now have I'm sure, very interactive discussion. I thought it would be helpful to take a step back and talk about the use of the word contribution. In the impact principles, we use this as part of our definition. You're contributing to a positive, measurable environmental or social impact. And the word contribution really came from the 5 dimensions of impact of the impact management projects. And contribution was a much better way to define what we're looking for in an impact investor than generate or deliver. Contribution, it's something beyond just it's the capital, but it's what you can do beyond just putting capital into an investment. And it's one of the 3 key pieces of impact with ESG as the foundation, but then you must have intentionality, be able to articulate how your capital contributes to the impact achieved, and then measure the impact. So with that, how important are you finding contribution is to your shareholders, your LPs? So I'd like to hear how you have that discussion with your investor base and your shareholders. And that's a question for all three of you. So whoever would like to start, I leave it to you.
I can kick off if you want, Diane. So I think for us, this is really essential. You know, we are an impact investor, and profit with purpose is our mandate. And so this is why LPs are often interested in us and attracted to us. And a lot of their due diligence on us is understanding how we define contribution and how we actively engage with portfolio companies. And this is where the impact principles really help, because they've helped us clearly articulate how we define and provide that contribution. Then at the same time, also with our portfolio companies, I mean, they're selecting investors, they're approaching investors. They want to be with investors who are going to help them grow their business. And in our case, so many of the founders and entrepreneurs we're backing have this real impact and social and environmental purpose mindset. So we see on both sides, the portfolio company and the LP really want to understand and know that we're actively engaging.
I'm happy to go next. I think so. We have obviously quite a unique position as sort of solely funded by a government. So I mean, I think that means really it's absolutely critical to what we do, because why would you put public capital behind something that the private market could do? So the question is simply, are we really additive? I think one of the points maybe I could just reflect on is many of our peer organizations, other development fund institutions, use the word additionality to talk about this. We explicitly took the decision 3 years ago to move to contribution. And specifically, we use that to really bring in this idea about like, what is the impact we're contributing to, and step beyond just that we're bringing something different and really focus on what's the impact of that thing we're bringing that is different. And I do think that's some of the real value in the word contribution, is it makes you think right the way through to what really am I bringing that's making a difference and moving the needle here.
You know, from our perspective, I think it is increasingly important, you know, the contribution piece. I think across the whole spectrum of sustainable investment strategies in a portfolio, the distinction around impact is this piece of additionality, is this contribution, is, you know, what is that particular investment bringing above and beyond, you know, the kind of baseline expectation. And so, you know, contribution, our end investors are private investors, individual investors, all the way through to family offices. And I think the sophistication and understanding of what they're trying to achieve with their capital and really bend the curve and exceed the baseline is exactly why it is a differentiator, and therefore the contribution piece is essential. It's what differentiates strategies from simply, you know, aligning to whether it's the SDGs or other outcomes that they're looking to achieve. And so, you know, the solutions in a portfolio that are identified as impact investments really do need to demonstrate contribution. Otherwise, it really doesn't achieve anything above and beyond other types of solutions in a portfolio. So I do think it's a critical element. And I think that, you know, we see end stakeholders really moving towards identifying that and differentiating it. And so I think it is important. It's going to become even more important in the years to come.
Right. Thank you all. There's a question for both Julie and Rob, which I think is going to be very helpful. This they'd like to have some examples of how you've considered contribution using specific investments to make it live. So if you could just provide 1 or 2 examples of how you articulated the contribution for some specific investments. And Julie, if you'd like to start, this would be great.
Yeah, great. So one that we often talk about is in Ghana. We are invested in My Life insurance provider, and so our ambition with My Life is financial inclusion and financial services. And when LeapFrog was invested in them, their services were mainly for employed, you know, their insurance offering was mainly for employed individuals. But by bringing in a consumer insight specialist and working with My Life, we were able to help them create more micro insurance products So then they could go out to have more non-traditional profiles. So they didn't have to only insure full employed individuals. They could find individuals who needed insurance for shorter duration, so these micro products, and also individuals who weren't in traditional employment. So that's just sort of one example. We have many examples across our portfolio on, because we're in Africa and Asia, and some of the environmental and social guidelines that are being rolled out sort of more mainstream in Europe may not always be rolled out yet with those companies. We have a lot of experience with most of our portfolio on helping them create environmental and social action plans as well.
Great, thank you. Rob?
So maybe I'll give two different examples. So one, very much thinking about the concept of confidence I spoke about. So we've made quite a few investments in the venture capital space, particularly in India, and that's been a market which has been really active in recent years. It's been somewhere where there's been a lot of participants trying to get involved, but we've really taken a strategy that we see technology as change in the way that it can drive particularly inclusion. So it can drive down costs, it can drive down ability to reach people with lower income levels, and it's really a way to open up services and products to lower income groups. And so we've gone in with that very intentional strategy. But in each case, it's been taking a view on what is the chance of a particular investment getting capital from elsewhere? And obviously, if it's getting capital from elsewhere, there's not a role for us. In recent months, we've seen liquidity tighten in that market. We've seen interest rates rising, more pressures on cash flow, and investors have been less active. And we've seen our financial contribution push up as that's moved through. So we've got more confidence in terms of where we are. But in each of these cases, it's continually thinking the market dynamics are always changing and weighing together how significant the impact opportunity is with that level of confidence around the capital available. Maybe if I could flip into one that really leans into where we're bringing value to a transaction. So we, together with Norfund, own Globec, which is the largest power developer in Africa. We actually created a strategy to put that business and that developmental strategy to focus on harder markets in Africa together. But what we needed to do was find management capability and assets and people to be able to develop those projects and deliver them. So that required us acquiring some assets and acquiring the management capabilities of Globec, but changing the strategy. So aiming for a strategy which was focused on much poorer markets where there was the development going on for power projects. And now we see a really strong pipeline of deals coming through that otherwise wouldn't have happened. So really there, the focus was on creating that strategy and the intentionality that was at the root of it.
Thanks for those great examples. There's another question, and I'm going to ask Andrew to start to address this. There's someone who's been fundraising in the MENA region, and they are saying that thus far they haven't really found that LPs are that interested in the non-financial contributions. They're more interested in the financial returns. And this is, I'd love to hear your perspective as an asset owner, Andrew, about, hasn't there been an evolution that now people appreciate the fact that these non-financial contributions do play into what the actual financial returns are at the end of the day? So I believe.
Yeah, sorry, Dan, can you hear me? You cut out for a second there.
Yes.
Great.
Yes.
Perfect. So I think that the comment is actually the right one, which is, you continue to have investors focused on the return opportunity and how it fits into portfolios and being able to underwrite it just like they underwrite, a traditional investment. But what you increasingly see as a focus on the, I don't like to call it non-financial. It's just, it is clearly financially material. But I think it is up to, fund managers or investors, excuse me, to demonstrate how these outcomes and achievement of the outcomes and the opportunity in achieving those outcomes actually does intersect with the financial piece of it. And I think that's the key that will convince investors over time to recognize that investing for impact is not about concessionary returns. It belongs and the market return or better portion of an investment portfolio. But I do think the comment's right. That is where we are right now, and I think a lot of people, if asked, would say I prioritize financial performance, and that's the decision I'm going to make from an allocation perspective when putting something into the portfolio. But we see an increasing view on understanding how does whether it's the ESG portion of it, or whether it's outcomes and the achievement of outcomes, how does that intersect with the financial performance, such that collinearity or prioritizing the outcome piece of it actually does drive towards performance. But I still think we're in this era where people will prioritize the financial performance piece of it. I think the investor contribution and everything that we've talked about play very much into this intersection of how does impact work together with performance.
I like you're using the word intersection, because what you often hear is there a trade-off between, the financial contribution and, well, let's not say non-financial, but other contributions that are made. So rather than saying there's a trade-off, there's an intersection. But Julie and Rob, would you like to, provide your view on that?
Great. Well, I think at LeapFrog, we're really setting out to demonstrate that profit and purpose are side by side. And so I agree with Andrew. If you look back maybe in the past 5 to 10 years, we're seeing, financial returns are driving investor decisions, but there's been so much progress in integrating non-financial material issues into investment decisions. And it's really exciting to see the shift in the marketplace, and to also see the frameworks and tools for analyzing material non-financial issues. So I think we'll hopefully see this continue to grow, and the tools improve and the rigor improve, and more evidence to demonstrate that profit and purpose and topics that are often considered non-material are actually very material and really important for the sort of future we want to create in sustainable investment.
Yeah, I think we're heading towards a more sophisticated world of people being able to choose the kind of balance they want. And I think ultimately we're going to get to a place where we have much more sort of segments of focus on contribution, of some organizations who are really focused are in a sub-commercial space, making below market returns and offering huge amounts of assistance alongside that. And maybe some others acting in public equity spaces, being sort of active players in that space. I think that's how a market should develop. It should have different players with different choices, offering different sections out to the market. And I think we will sort of slowly get there. I do think there is this challenge in when you're offering value, so offering the non-financial piece. It's just how much should you offer? So you can always offer more. And I really think the key is focusing on those things which are really aligned with the core impact of the transaction or the core risks of the transaction. So really focusing on those things, because generally what you're doing with advice is you're improving the quality of the impact outcome. So generally your financial contribution enhances the quantity and your value enhances the quality. So you really want to focus on those areas that can make the biggest difference, and actually hold yourself to account of not doing everything. Because you can always do more. What are the things really where you've moved the needle, and then maybe you should focus your attention somewhere else on a different transaction to really maximize the overall difference you can make.
Great. There's a very specific question, and this is directed to Rob and Andrew, about most contribution people are thinking in the equity space, and mostly private equity. Is there any compelling way that a debt investor can demonstrate contribution? So that's a question. Rob, if you'd like to start with that.
I mean, I think there are many ways. It's obviously harder to have influence in a way you're looking at strategy, but we find the companies our borrowers who we offer debt to are just as happy to receive our value add services as equity equity investees. But similarly, in terms of where you're offering something financially that wouldn't otherwise, offering longer tenor debt can be really transformational. If you're offering it to a business who really faces significant refinancing risk, can't actually get finance to the extent to which a CapEx project is breaking even. Like if you can offer that longer tenor, if you can find a way to de-risk that project for them, for it to happen, that can make a huge difference out there. So I think sometimes we tend to be a bit legalistic in thinking about the differences between equity and debt. You're obviously not on the board, but often having the conversation with your borrowers, they're just as interested in the opportunities as those where you have a shareholding.
Great. And Andrew, as an asset owner, when you're investing in debt, how are you looking at contribution?
I'd agree with everything that Rob said. I mean, I think certainly you do sit in a different place in the capital structure with regard to debt. And so you have different influence versus the types of things that we've been talking about here. But I do think it's about the provision of capital, right? And where you're able to provide capital to what types of enterprises, and thinking about being more catalytic, thinking about bringing capital to, again, enterprises that didn't have that, as well as Rob was talking about longer tenor debt where that's needed. I think that's the type of differentiation that you want to see and that we'd like to see, whether it's on the private credit side or more on the public credit side.
And Julie, a question for you. Does it matter does the contribution change depending upon the stage of the investee, like seed capital, early stage? So can you speak to that?
Yes, definitely. So in terms of maybe not so much in the financing stage, but the maturity of the company. So as part of assessing on our due diligence, we will do an impact due diligence as well as an ESG due diligence. And a lot of that impact due diligence is what's the intention of this portfolio company? What consumers are they trying to reach? And how could we help them reach more consumers? So the example I gave earlier with My Life, trying to extend the reach to lower income or individuals in non-traditional employment. So it depends more on the maturity of the company across delivering their product and service or across their ESG priorities. So it's more, because we find a real mix. I mean, some companies have a strong, say, impact ambition, but maybe they need more skills on product development. We see that a lot. Or some companies have grown really quickly. They're really purpose-driven, but they need more capacity and capability around governance and talent and people development. And then we have some that are super ambitious and wanting to do everything on ESG at one time. And so we'll try to work with them to be paced around what's material, to that business and what's really going to help them drive change.
Rob and Andrew, would you like to comment on the, different stages of companies and contribution?
Yeah, I think it is something where it can often be easier to find contribution in a less developed market, and that's similarly with a less developed company. Like there's more risks there. People are going to be less willing to take it. It's less understood, less developed. So there's more space for someone who's willing to take that to go out there and sort of find it. I think one of the challenges in kind of thinking about this is actually, how do you think about targeting the right contribution to the right people? So quite often, as Julie was saying, those early stage companies, they can just need really some of the basics of kind of how to run a company well is the right place to start. And sometimes it can be build up the ambition slowly. One of the things we're also really trying to think about more and more is our contribution over the life of an investment. So you would expect as a business grows and becomes more stable, that actually your contribution as an investor would fall to a degree, and the market would be more willing to take on that investment without a public institution involved. And thinking about what's the right time to exit. How do you think about that in terms of, is my role done? Is it time to hand over the torch to someone else? So there's all these interesting trends playing out at the same time.
I think that's a great point, sort of the differences in investor contribution by stage of company or by stage of enterprise. And I do think we're still kind of trying to figure that out, right? Different stage investors are looking for different things. But I think in the kind of DFI or asset owner world, I think there are different ways that we can push, right, to influence more. I think sometimes at earlier stages, companies might actually be less willing to take, advice or guidance or what have you, because they're so prone to, well, we might pivot our business model in a short period of time. But I almost think that as an investor, you want to be more active in terms of helping to guide and so forth, insofar as it falls within the change that you're trying to drive. And so I think it is a balance between, asset owner, asset manager, and underlying enterprise. But I think it's a great point that Rob makes about the differences in investor contribution across the life cycle of a company or investment.
And if I can follow on with you, Andrew, on that, there's a few questions about contribution in public markets. So we had a webinar, the Impact Principles had a webinar on investor contribution in public markets. Can you just provide some of the highlights of your perspective on how you are able to contribute? And it's, again, these are more advanced, companies. These are older companies, more mature. So if you could speak to that.
Sure. I mean, I think a lot of the comments that we've made have been within the private market space. And I think, our view is there is the possibility of driving impact at the asset manager level or at the asset owner level in public markets. But I think it's harder right there. I think in public markets, if you want to have impact, you really, again, to go back to that point of differentiation, you really need to differentiate, like, what is it as an investor that you're doing above and beyond to drive incremental impact. So it's not about the companies that you're invested in so much, whether they have a business model that's contributing positively from a products and services standpoint, but it is about saying, what is the above and beyond? Why isn't this just a thematic fund, for example, in public equities? Because the underlyings are liquid, there are many investors that can come in and out of investments. It can be really hard to demonstrate contribution. So, in our view, the key mechanism to drive, positive incremental impact is really around engagement, right? And I think the challenges there lie in, is your capital consistently there? Will you hold it throughout the investment period? And just to go back and apply a lot of the same principles, do you have a theory of change around what it is that you want to see change and why that relates to your long-term investment thesis? Are you actually setting out explicit targets for what you want to achieve? Are you going to measure, manage that over time? And are you going to report on that explicitly at the end? And then I think this question around attribution really comes to play in the public markets, where there are a number of investors around the table, and how and who actually helps to drive that impact above and beyond the company itself. I think these are the questions that come into play. So we do think it's possible in other asset classes, and you do need to apply the same principles so that you're relatively consistent when you look across a portfolio and say, have I achieved impact in the same way as I thought I could in private markets? What is happening in public markets, and is it the same degree or is it a different flavor within my portfolio? But I don't think people should assume that impact can just be had via private markets or real assets type of instruments. We're looking at every single area within a portfolio across asset classes and strategies where you can. It's just about that consistent application.
Thanks so much, Andrew. That was a great answer. We're getting so many great questions. I hope I can get to all of them, but this is an interesting one from one of your fellow signatories we're talking about assessing contribution at the investment stage. Do you reassess this or revisit this assessment ex post? And if so, how do you do that? And any of you may answer that question.
I'll have a first go. It's really hard, is the answer. It's really, really hard. We do look at our contribution through our sort of monitoring. We look at actually, are we delivering what we expected? But that is, pretty only one part of the puzzle. The other part of the puzzle is that part you can't observe, which is what would have happened otherwise. And that's a really difficult part to understand. We have used our client surveys to try and understand the value they gain from our non-financial offers particularly, and to try and understand some more of that dynamic. But ultimately, I think this is part of the challenge. Is ultimately it's unobservable what would have happened otherwise, and the counterfactual. And I think it's just about continually asking the honest questions and holding a stronger view as you can as to what you're doing and in which direction things have moved can help you build up the picture. But you can never prove it, and you have to make peace with the fact you can never prove it.
Yeah, I think I can build on Robert's points. It can be challenging to prove, but the way we try to tackle it is, in the starting point, trying to really focus the contribution, the value creation around what's material, and then track that along the pathway to exit. So, LeapFrog has historically done that, but we're trying to spend more time now really going deeper in the beginning on what's material, what is the company really committed to wanting to do as well, because you both need to have that real commitment to provide the support, and then try to measure that contribution. And sometimes it's really straightforward if it's a product or service. Yes, maybe another investor could have done that, but increasingly I'm starting to think, well, they could have done that, but they haven't done that. So, we partnered to try and work with the company to drive that change. But yeah, it's a good question. And I think one, as an industry, we need to keep working on trying to measure better.
Great. There was this is coming up a lot more, and there's actually a question about the assessing negative contribution and how that factors into the overall, assessment of the impact and your contribution. So would any of you like to speak to that?
I hope I've got the idea of negative contribution correct. Is that sort of you as an investor may actually not be the best investor for a transaction. So you may be one, your intentionality actually might not be the best pathway to get the greatest impact out of a company, and you may divert it away from a pathway which another investor could deliver better. I mean, I would say on occasion we've had that discussion, particularly in transactions where we're looking for a business to take a more developmental strategy. Maybe if we're looking for a sort of a control position as part of a consortium, and we're looking to do something different, we have had that conversation of actually, is a DFI really best placed to drive a business in this way and have the best outcomes? And might it be better to leave the market to deliver it and make more impact happen in that degree, even if it's not as intentional as we intended. But it's really difficult. I think one of the areas that contribution actually really helps to avoid negative impact, like more broadly, is really targeting at the risk to impact. So I think quite often a lot of value add in contribution really comes from addressing risk. So that can be customer protection, for example. Really focusing on those areas where there are risks in a transaction. Actually, it really can help mitigate those aspects. I hope I've understood the question correctly.
Yeah, it's really about assessing and measuring, and it's, as you said, it's difficult because it's generally unintended. You're not going into the investment to do that. But then following, you made a comment. There's a difference between qualitative contribution and quantitative contribution. So there was a question about how do you express qualitative contribution with and avoid having it look like it could be impact washing, because it's not, it's not black and white, it's not numbers oriented. So could you speak to how you distinguish between the two, how you measure the two? Is there a trade-off between the two?
I think that's sort of question of I tend to think of financial contribution as really about quantity of impact. It tends to be, you expand a business, maybe a manufacturing business, you expand a production line, you get more impact out of it. Quite often, value, you can improve the impact from it. So really thinking about, maybe it's about who's employed on that line, or their working standards, or the conditions, or whether they have some employee ownership or other thing. You can think about ways which enhance the quality of them, but all mitigate risks. I do think you have to be quite careful in balancing the two and understanding the overall impact that comes out of them. I as a publicly funded investor in private markets tend to think of the financial as the cake and the value as the icing on the cake, and both are important, but keeping the relative magnitudes sort of in hand are kind of a key to understanding what's there. I think the other part you have to be careful on is there are activities which, if you take the view that you're only focusing on your value contribution as those things that others wouldn't do, you do still have to do the activities that others would do once you're in. So, for example, others might work on board effectiveness and good corporate governance and other things, but any investor may focus on those things. They may not actually, you may not be driving impact through those because somebody else would do them, but you still have to do them for that impact to happen, and actually making sure that all of those pieces come together and you keep a view on the whole piece. But you don't just focus on activity, you really focus on what the activity is that drives impact, is how to do it. But it's like anything in impact management, adding apples and oranges is hard, and really just keeping a view on what's the big picture, what are the overall magnitudes, and where are they coming from is where we focus.
Julie and Andrew, would you like to talk about, how you're defining the contribution? The comment in the question was, what if about using multipliers or language such as we touch the life of, X amount of people, and making sure that can be a hard assessment, but it doesn't necessarily translate that way.
No, exactly. I think it's a really important question around transparency in the industry as well, that we're all very clear and authentic in how we're communicating. So we have a range of numeric targets and data points we put out, but we try to be clear with our definitions around what is a direct number we're measuring and what may be something that's a multiple of reach. And whenever we're using multiples, we're trying to always base that on either IRIS Plus definitions or UN or World Bank. If we can't find the definition there, we sort of stop and say, okay, maybe we shouldn't be making a multiple here. But then aligned with that and our theory of change, trying to go deeper where we can to really look at the outcomes and the impact. And as Robert said, surveys can be helpful for that, or bespoke pieces of research with service providers to really collaborate with the company to understand what is the intended impact here, back to Robert's point about the big picture of social change or economic impact we're trying to have. So I do think it's a journey. It can be resource intense to do some of the deeper analysis, which I think is always balanced. But for us, we really just try to be clear, transparent with our definitions so that there's, no intent of being misleading.
I think the only thing that I'd add to all of those comments is the more explicit and directly connected to the investment at hand it is, the better it is for everyone in this value chain. I think to the extent that you get a little bit farther away from it, making sure that there is evidence to support the assertion that that end impact is being had. I think that's important, but connecting the two as closely as possible to the specific investment, I think that's important, as opposed to having some sort of a number that's aggregatable across the portfolio in a roll-up scenario. I think I'd rather have the former than the latter.
Great. And this is a question for all of you. Can you describe some tricky investments, to use a technical term, where you found it really difficult to determine contribution? For example, Andrew, I don't know if you have large cap equity strategies, and how do you assess contribution there? But it'd be interesting to hear where you're finding challenges in assessing the contribution.
Yeah, I can start. I mean, look, we talked a little bit about public equities earlier, and I do think that that's a tougher place, and it's doable, but it's harder to prove that contribution, and maybe particularly from the perspective of attribution, right? Because there are so many participants or players or active engagement around the table. as well as, the corporate management itself. So I do think public equities is harder. I think people have to be thoughtful where they're asserting that they are driving impact in the public markets. It can be a tricky place, but it's certainly doable. It's just, as Julie and Rob were saying before, you just have to be clear and be able to support the assertion.
And Rob, would you like to speak to any kind of tricky investments from your perspective?
Yeah, sure. I think some of the ones which are often, and it maybe links a bit to the last question, the ones which can be most tricky are ones where the impact's really obvious and clear, and everyone likes that the impact is really obvious and clear, but the contribution is really hard to get your finger on. And so it's actually like we can all be prone to sort of anchoring to this fixed thing, but actually the thing that matters is the sort of intangible that you're struggling to get a hold of. I'm not going to mention the specific name, but certainly we had one which was it was a competitive bidding process. So, a bidding process is set up to presumably have multiple participants, but for none of them to really know what the others are doing, offering and planning at a particular point in time. It was together with a strategic partner was needed to sort of execute the scale of the business being offered. And this market didn't exist. There's a government player in there, an incumbent, but actually it's not a market with many players and many actors in there. So very little information on what was happening. A sort of large, well-funded strategic, but a project which is incredibly high risk, incredibly far from their comfort zone, and very big ticket in terms of the capital it needs, alongside a number of other bidders, us unsure how many, also potentially backed by public funders. So sort of we take a view that we look at ourselves in a peer group. So it's not that sort of we can't differentiate ourselves from our equivalents in other countries. We think about ourselves as a kind of peer group that we work through. So that created us a huge number of problems. And we were actually really cautious on our contribution level when we first went into that. At the end of the bidding process, we were once we saw the results, we were we shouldn't have been so worried. And the reality is this point, you can never know until the information is revealed. And you can be wrong in all directions. And the key is just trying to get to the right answer through the process.
Julie, would you like to speak to some more difficult, challenging investments for contribution?
I think for us, again, we're in this sort of unique situation where we're directly investing, and our starting point is for investments that have a demonstrated track record in positive social impact. So we're trying to enhance and build that. So I think from the sort of starting point of building a value creation pathway around impact, that's straightforward for us. But obviously there'll be some investments where maybe the company has been a family business that has grown, and they've had fewer investors coming in and setting expectations on them on, what is global best practice that's expected around impact measurement or environmental or social matters. And so some of those conversations have to be deeper and longer dialogues, with the company. But I think we're able to bridge those gaps usually because the investor knows the company knows going in that LeapFrog is an impact investor, and it's very clear from our early engagement with the company.
Great. Thank you so much. You guys, we are almost at the end of the hour. This has been an incredible discussion, and the questions from the audience were really, really helpful in getting into a very in-depth discussion. If any of you have final comments, please take a minute, and I give you the floor, and then we'll wrap up.
I'll just say thank you to Diane and VII for hosting this. It's great hearing the questions and seeing the depth of growth in impact and contribution. So thanks everyone for participating.
Yeah, I very much echo that. I think one of the most interesting areas of contribution which is starting to come out is this. I think really what matters with contribution is doing your analysis well. And like, we shouldn't expect all investors in different products at different parts of the cycle to be doing the same thing, or have some form of kind of superiority that some part is better than another part. Sort of my vision for the financial world is that everyone thinks about impact as they're investing. And that means all products and all sectors actually need to have a view on contribution. And in some areas, it is really hard to deliver contribution. And there may be people trying really, really hard, but actually in a market that's difficult. And I think public equities looks like that a lot of the time. But when you get to a tipping point that you have a number of investors acting in the same way, suddenly it starts having much more impact. So I think this increasing sophistication is really, really good to be seeing. And I just think it's been a very valuable discussion.
Yeah, I'd echo this last point. I think that Rob makes about not being better or worse. It's about different ways to do it across different asset classes. And so I think for me, when it comes back to the portfolio context, the more that we can see that, the more investor contribution that's done, that's thoughtful and authentic and really connected directly to the particular strategy or asset class. That's what we really want to see in order to be able to increase impact ultimately over larger parts of or more parts of a portfolio.
So I think what really came through quite clearly is, just as in many other areas of impact investing, there is no one size fits all. This is a very diverse market. You've got different stage companies, different types of investors. You have, different asset classes. So the way you were able to bring it all together and give the different perspectives, I think was very, very helpful. And again, it's developed, as you said, Rob, this is evolving. It's becoming more sophisticated. The more conversations like this, it's going to make it much clearer to the market. But the importance of contribution is increasing. It is a conversation I'm hearing much more frequently. So this is great timing to have this webinar. And thank you so much for BII stepping up to run this series of webinars with the impact principles. And we look forward to some of the future topics, which would be impact scorecards and also impact linked incentives, which is increasingly important to investors, we're hearing. So I want to thank everybody for joining. Again, this will be recorded and available to you on the Impact Principles website. And thank you, Rob, Julie, and Andrew, for a great discussion. Thanks, everybody, and bye-bye.
Thank you.